My name is Pat Keown. I'm a senior research analyst with Lipper, and I'm here to speak to you about fund flows activity for the week ended Wednesday, April 1st. We'll start this week's report by taking a quick look to see what our fund asset groups did this week. Money market funds, as we've seen over the past month or so, were the big winner here. They took in $164 billion in net new money as investors still seek to wait out this market uncertainty and park money on the sidelines. Equity funds took in $6.5 billion in net new money. Taxable bond funds saw net outflows of $17.8 billion, and muni bond funds had net outflows of just around $700 million for the week. We'll turn our attention now to the market activity. As you can imagine, it still continues to be volatile, so we'll take a look at that and see how it impacted this week's fund flows. The optimism in last week's markets, which were driven by the $2 trillion stimulus package, was replaced by America starting to come to terms with the grim reality of what the actual cost of COVID-19 will be in terms of the loss of human life and the halting of the economy. After posting encouraging gains last week, coming on the heels of 2 consecutive fund flows trading weeks of double-digit percentage losses, the equity market started off the week in strong fashion but nosedived during the last 2 trading sessions to finish the week in the red. Overall, the Dow Jones Industrial Average, the NASDAQ Composite Index, and the S&P 500 Index were off 1.21%, 0.32%, and 0.20% respectively for the week. This week's poor performance contributed to the Dow posting its worst quarterly results since 1987, and the S&P 500 logged its worst quarter since the global financial crisis. The tenor of the war against the virus seemed to take a more somber tone this week. Over the weekend, President Trump announced that the federal social distancing guidelines, avoiding non-essential travel and limiting gatherings to no more than 10 people, will be extended at least until April 30th. Just a week earlier, the president had floated the idea that these restrictions might be able to be lifted in time for Easter, which was April 12th. Dr. Anthony Fauci, a member of the White House task force on the virus, stated that the extension of these guidelines was necessary because their data indicated that the spread of the virus was not slowing down and it was not expected to peak till at least several more weeks. The task force also communicated in their daily press conference this Tuesday that their internal models have projected that the death toll in America will be between 100,000 and 240,000 people, which is a best-case scenario. The aforementioned equity indices each retreated roughly 4.5% in trading the next day in reaction to this sobering news. The bad news on the economic front was widespread, as could be expected when a country purposely shutters large sectors of its economy. Included among the shocks were record high weekly unemployment claims of 3.3 million and data released on March 26. To put this number in perspective, the previous high was 695,000 almost 4 decades ago in 1982. And during the global financial crisis, new weekly unemployment claims peaked at approximately 650,000. The Federal Reserve Bank of St. Louis published a study during the week indicating that they expect jobless claims to go significantly past this initial number by the time the virus and its impact has run its course. The study speculates that COVID-19 could put a total of 47 million Americans out of work. If this level is achieved, it would equate to an unemployment rate of 32%, surpassing the previous high water mark for this stat of 25%, which was reached during the Great Depression. The unemployment numbers released the morning of Thursday, April 2nd, seem to suggest that this might be achievable, as 6.6 million new claims were filed, more than double the record set the previous week. Let's turn our attention back now to the fund flows activity. We'll take a look at a deeper dive with each one of our fund asset groups in closer detail, starting with equity mutual funds. It was a bit of a surprising result for this group in this turbulent market. As I previously mentioned, they took in $6.5 billion of net new money. This broke a streak of 13 consecutive net outflows. Domestic equity funds accounted for the lion's share of the net inflows at $6.3 billion, while non-domestic chipped in about $224 million of net new money. Among the peer groups, large cap core funds and large cap growth funds had positive net flows of $1.8 billion and $1.6 billion on the domestic side, while international large cap growth funds turned in the best result for non-domestic equity funds with an increase of $752 million. We'll move on now. Take a look at our equity ETF group. Net outflows here last week. We saw $2.6 billion leave their coffers. The net negative flows for equity ETFs were driven by the Spider S&P 500 ETF and the Invesco QQQ, which saw net outflows of $4.8 billion and $2.4 billion respectively. Conversely, the iShares S&P 500 Growth ETF took in $1.5 billion of net new money. We'll move on now. Move on to our taxable bond fund groups. We'll start with the mutual fund side of things. As mentioned earlier, they had net outflows of $17.8 billion for the week. While this is a fairly sizable number, it was actual market improvement from the week before, where they had record-setting net outflows of almost $54 billion. The majority of the peer groups in the taxable bond funds suffered net outflows for the week, with the worst belonging to core bond funds and core plus bond funds at $3.8 billion and $3.4 billion of net negative flows respectively. We'll take a look at the taxable bond ETF group now. Conversely, we saw net inflows on this side, on the ETF side of the ledger for taxable bonds, as they took in $8.6 billion in net new money. These net inflows were paced by the iShares iBoxx Dollar Investment Grade Corporate Bond ETF and the Spider Bloomberg Barclays High Yield Bond ETF, which took in net new money of $4.7 billion and $1.5 billion respectively. The largest net outflow, Spider Portfolio Short-Term Treasury ETF at $1.2 billion. Moving on now, we'll look at muni bond funds. This group, net outflows here as well last week. They saw $725 million leave their coffers. The major contributors were the general muni debt and the short muni debt peer groups, which had $353 million and $294 million leave respectively. The last group to take a look at is money market funds. As mentioned during the introduction, another big week for money market funds as investors wait out this volatility. Net inflows of $164 billion this week. Again, very strong, but not as strong as last week's, where we saw $259.8 billion go into the asset group. So, a decrease of $100 billion there from last week's net inflows. And similar to last week, the peer groups that drove the net inflows were the institutional U.S. Treasury money market funds and the institutional U.S. government money market funds, which took in $78.6 billion and $68.2 billion in net new money, respectively. Well, that wraps up this week's report. If you'd like to take a closer look at the data for yourself, please go to our website, which is www.lipperusfundflows.com. And please join us here again next week, where another one of our analysts will be speaking about the week's fund flows activity.